An emergency fund target of $15,000 can feel impossible when you are struggling to find even $100 at the end of the month. That is where many people stop before they begin. They focus on the final number, feel overwhelmed, and tell themselves they will start later when their income is higher or life is less expensive. But an emergency fund does not have to be complete before it becomes useful. The first $500 could keep a small car repair or medical bill from becoming new credit card debt. The first $1,000 could create breathing room when income is delayed or an urgent household expense appears. The goal is not to build the entire fund overnight. The goal is to build protection one layer at a time. In this video, you will learn how to choose a realistic first target, find a contribution your budget can support, save when income varies, and balance emergency savings with high-interest debt. This video is for general educational purposes and is not individualized financial advice. Let's begin. Step 1. Choose your first layer. Your complete emergency fund may eventually equal several months of essential expenses, but that is not your first assignment. Start with a buffer for the smaller financial shock most likely to affect your household. For one person, that might be $500. For another, it might be $1,000. If you depend on an older vehicle, your first target may reflect a likely repair. If your income varies, it may cover one essential bill during a weak month. Choose a number that is meaningful but reachable. Then build in layers. First, complete the starter buffer. Next, work toward 1 month of essential expenses. After that, continue toward your complete emergency fund target. This changes the question from, how will I ever save $15,000? to, what is the next layer I can complete? Step 2. Find an amount you can repeat. Do not choose a savings amount because it sounds impressive. Choose it because your cash flow can support it. Start with your average monthly take-home income. Subtract housing, groceries, utilities, insurance, transportation, necessary childcare, minimum debt payments, and other essential costs. Then account for irregular necessities such as medication, household supplies, and routine vehicle expenses. What remains is your preliminary saving capacity, but do not automatically transfer every remaining dollar. A plan that leaves your checking account dangerously low can create overdrafts, missed bills, or repeated withdrawals from savings. Consider Sarah. Sarah brings home $4,200 per month. Her essential expenses and minimum debt payments total $3,700. She usually needs another $350 for flexible and irregular spending. That leaves about $150. Instead of saving the full amount, she begins with a $100 monthly transfer and keeps $50 as breathing room. After 2 months, she reviews the result. If the transfer feels stable, she can increase it. If she repeatedly moves the money back, the contribution is too high. The best contribution is the amount you can repeat without destabilizing the rest of your finances. Step 3, create temporary savings capacity. When money is tight, there may not be an obvious extra $100 in the budget. In that case, look for a temporary adjustment rather than a permanent lifestyle overhaul. Review the previous 2 or 3 months of spending. Choose 1 or 2 flexible categories that can be reduced for a limited period. That might include unused subscriptions, restaurant meals, convenience spending, optional shopping, or entertainment. Do not cut essentials, such as groceries, medication, insurance, or necessary transportation. The goal is not punishment. The goal is to redirect a manageable amount for a defined period. Reducing flexible spending by $30 per week creates about $120 per month. Over 6 months, that becomes $720. Give the plan a finish line. For example, for the next 6 months, I will reduce these 2 categories until I reach $750. A temporary adjustment is easier to maintain when it has a clear purpose and an end date. Step 4. Automate carefully. Saving becomes harder when you must make the same decision every payday. Automation can reduce that friction. When your income is predictable, schedule a small transfer shortly after each paycheck arrives. $25 per week becomes about $1,300 over 1 year. That may not complete your full emergency fund, but it can prevent a smaller expense from becoming new debt. The timing matters. Do not schedule the transfer before your paycheck is available. Account for rent, utilities, insurance, and debt payments. If the transfer repeatedly causes overdrafts or forces you to move the money back, reduce the amount or change the date. Then increase the contribution when cash flow improves. A raise, a paid-off debt, or the end of another expense can free money. Before it quietly becomes new spending, decide how much will go toward your emergency fund. Step 5. Adapt the system when income varies. A fixed monthly transfer may work poorly for a freelancer, contractor, commissioned employee, or seasonal worker. When income changes significantly, use a percentage-based rule. Identify a conservative baseline month, then save a percentage of income above that amount. Consider Michael. Michael's baseline take-home income is $4,000. During a stronger month, he earns $5,000. The difference is $1,000. His rule is to save 20% of income above his baseline, so he transfers $200. If he earns $4,100, he transfers $20. The contribution adjusts with the income. For self-employed workers, money reserved for taxes and necessary business expenses is not personal emergency savings. Keep those categories separate. You can use the same intentional approach with one-time money, such as a tax refund, work bonus, overtime pay, or a cash gift. You do not have to save all of it, but decide on the allocation before the money arrives. The important principle is giving the money an assignment. Step 6. Balance savings with high-interest debt. Many households are trying to save while carrying credit card debt. High-interest debt is expensive, but having no emergency savings means the next unexpected expense may go directly back onto the card. One practical approach is to keep essential bills and minimum payments current, then build a small starter buffer. After that, direct most available cash toward high-interest debt while maintaining a small savings contribution. Once the debt is eliminated, redirect the former debt payment toward the next emergency fund layer. This approach will not fit every household. Debt costs, income stability, workplace benefits, and household risks all matter. The principle is that debt repayment and emergency savings can work in sequence instead of competing forever. Step 7. Separate predictable costs from emergencies. Some expenses feel like emergencies only because they were not planned for. Vehicles require maintenance, insurance premiums renew, homes need repairs, annual registrations and school expenses return. These costs may not occur every month, but they are reasonably predictable. When possible, create a separate sinking fund for the category most likely to affect you within the next 6 to 12 months. A sinking fund is money reserved for a known future expense. This keeps your emergency fund available for events that are genuinely unplanned. Keep emergency savings safe, accessible, and separate from everyday spending. For many households, that may be a dedicated savings account at a federally insured bank or credit union. Maximum growth is not its primary job. Reliable access is. Your 30-day action plan. First, write down your starter target and your complete long-term target. Second, review your previous 2 or 3 months of spending and calculate what is genuinely available after essential expenses and minimum payments. Third, choose a contribution you can repeat during a normal month. Fourth, select 1 or 2 flexible expenses to reduce temporarily and give the adjustment an end date. Fifth, place the money in a separate, appropriate account. Sixth, schedule the first transfer after your next paycheck arrives. Seventh, create a percentage rule for your next bonus, refund, gift, or stronger income month. Then review the system after 30 days. Ask, did the transfer create financial stress? Did I have to move the money back? Can I increase it slightly? Should I reduce it? Adjustment is not failure. A useful financial system should change when the evidence shows that something is not working. Final summary. Building an emergency fund when money is tight is not about finding one dramatic source of cash. It is about creating a repeatable system. Start with the first layer. Choose a sustainable contribution. Make temporary and realistic spending adjustments. Automate carefully. Use a percentage when income varies. Give one-time money an assignment. Balance a starter buffer with high-interest debt. And use sinking funds for predictable expenses. Your first transfer may feel small, but it begins creating distance between an unexpected event and long-term debt. You do not need a perfect month to begin. You need a contribution that can survive a normal month, then another, then another. That is how a small buffer becomes 1 month of essential expenses, and how 1 month gradually becomes meaningful financial protection. If this video helped you create a realistic emergency savings plan, subscribe to Wealth for Legacy. We create practical financial education designed to help you build wealth, protect it, and pass opportunity forward. Keep building your legacy.